Hey, this is Chris, and in this video I'm going to be sharing 5 different ways that you can invest for your grandchildren's future. I'm going to be comparing the 5 different ways and then at the end sharing which one I think is the best way to invest for grandkids for the long run, and a few of the things that I think you should consider when comparing different providers out there. So starting right off, the first way that I think a lot of people have invested for their kids and grandkids over the long run is just in a simple savings account or in term deposits or in a bank account. Now, historically, these bank accounts or savings accounts earned quite good returns and were a great way of helping kids learn about saving, topping up, learning about interest and the compound growth effect. These days, unfortunately, because interest rates are quite low, kids don't really see a lot of benefit from that compound effect. To give you an example, these days with the variable interest rate at a big bank like Westpac at 0.15%, it's going to take your grandchild 280 years to save up from $10,000 to $20,000. So it's going to be a very, very long-term lesson and they're not going to really see those benefits. That's probably why I think a lot fewer kids are actually looking to save up and invest in bank accounts, just because the returns you get are so pitiful, and also kids have such a long-term horizon that you can afford to take a little bit more risk in order to earn a better return. So historically, I had a Dolomites account when I was a kid, and I was lucky enough to have my grandparents contribute to that sometimes on birthdays or Christmases, but I just don't see that being a popular option or a great option for kids going forward. But historically, at least, that was probably the most popular. The second option, which I know a lot of grandparents have done, for friends of mine, is invest in shares. And I think a lot of my friends, got quite lucky where their grandparents gifted them shares in, BHP or Macquarie Bank or CBA when they were quite young, and now they're earning great dividends. Again, historically, I think this was a strategy that worked really well because those sort of companies have performed quite well on our share market. Those big names, the banks, Woolies, Telstra, Macquarie Bank, they've all been awesome performers over the last 20 years. The risk going forward is that they may not be the bright star performers of the future, and you really want your kids to be able to benefit from that compound growth. And what we know is that it's only a very small fraction of companies listed on the ASX that drive all the market returns, something like 6% of companies. So if you're thinking of gifting your grandchildren direct shares, something to really think about is, if it isn't those shares that perform well in the future, is it really going to give them a return or give them that growth or even give them that money lesson about, the benefits of investing for the long run? I think these days investing or picking direct shares is quite risky. And even a lot of, really well-known and smart money managers aren't able to consistently pick the right ones. I still feel lucky because my grandparents have held on to their CBA and BHP shares, and it's been a good lesson to hold on to them. But these days, I think there are probably better ways to help kids learn the lessons of diversification and actually give them a better chance of getting ahead than direct shares. Which leads me to the next option. So managed funds and listed investment companies is option number 3. Now, I think in the late 90s, when I started to learn about managed funds, it was when they started to really become popular, and I remember advertised in the newspapers in Australia. One of the problems is that generally the really well-known funds are the ones that then perform the most poorly. So back in 99, 2000, it was all these tech managed funds that came out. Over the last few years, there's been a few big name fund managers in Australia that had really great starts to their career, but then have had, pretty average performance ever since. So the risk you face with managed funds is just that, fund managers may change while your kid's growing their account. Their performance may come and go. What we know from the evidence is only about 15% of fund managers outperform just the broad market. So if you put your kids in that option or your grandkids, the odds are actually stacked against them, doing good in terms of consistent long-term returns. And listed investment companies is the same. I'll put the study below in the comments section, but we've looked at a comparison of Australian LICs compared to other options like index funds, and found over the long run most of them don't perform very well. So personally, I'd be avoiding managed funds and LICs. Generally their fees are higher, which comes out of the returns, and the performance they're able to earn doesn't compensate for these higher fees. it's certainly an option and gives better diversification than direct shares. I just don't think you get very good bang for your buck when it comes to performance versus fees. The fourth option is then investment bonds. They're often known as education bonds. It's quite a tax-effective way for investing for grandkids, and that's because the tax is paid earlier, and so by the time you hand over that portfolio to your grandkids in the future, when they become eligible for investing when they're 18, they don't need to pay any more tax. So these were set up, back in the 90s, often by insurance companies, and they're actually an insurance product. We've done a lot of analysis on these, and again, I'll post the study in the comments section comparing investment bonds to other investing options. And where they look great is that their tax when you hand over the money is much lower than if you bought direct shares or a managed fund or the next option I'm going to talk about, ETFs. The problem is that their costs are so high over that period of time and their returns aren't typically very good that you lose any tax benefit that you get from poor performance during the period that the investments are held. So theoretically, investment bonds are a great option, but if you actually look at the results over the last 20 years, they've been pretty awful, and they're a product that I think are just overly complex. The fees are too high, and I'd be avoiding them. I wouldn't be putting my kids or grandkids into them. Which takes me then to the final option, which is my favorite. It's actually one of the reasons I set up this business, Stockspot, was to help people get access to these wonderful investments, which are ETFs, and giving your grandkids a diversified mix of ETFs. Now, ETFs or exchange-traded funds are a great way to get access to a broad index of companies, which helps in a few ways. One, it spreads your risk, but also guarantees you own the winning companies of the future, and also does it in a really low-cost way. So more of the returns stay in your pocket or your grandkids' pocket rather than going out to fund managers. These days, there's hundreds and hundreds of these listed on the ASX, but you can either pick your own or go with a company like Stockspot where we pick them for you and then manage them. And what you want to make sure of if you pick this option for your grandkids is that, one, you're going to look for a higher growth option because they do have time on their side. So you don't want too much cash or low risk investments in there. You want them to benefit from fantastic businesses and their growth. Two is you want to consider regular contributions in addition to a lump sum, which will allow the kids to learn about dollar cost averaging, buying when markets are higher or lower, and then gradually growing their wealth over time. Make sure that dividends, which ETFs do pay, are reinvested automatically. So you get that compound effect, growth on the growth on the growth, which will help speed up the returns. And then low fees is critical as well. So maybe 20 years ago when returns were a lot higher, you could afford to pay higher fees to fund managers. These days, we all know interest rates are zero, but therefore the expected returns from the share market are also lower. You want to be keeping as much of that as possible or allowing your grandkids to keep as much as possible because the compound effect of fees over the long run is huge. And so you don't want to be looking at any products where you're paying 1.5% or 2% a year in fees. It's going to crush the potential for your grandkids to earn a good return over the long run. So there are a few factors I would consider, and that 5 different options. By far, I think the best one these days is ETFs. Whether you do it yourself or if you want to spend less time doing it, you can outsource to a business like ours. Broadly, what I would say is make sure that you're finding a business that's aligned with your own investing philosophy and how you want your kids or grandkids to be learning about money, and how you want them to be learning the lessons of compound growth, of diversification, of discipline, and the consistency, and what that actually yields over the long run. So, I think ETFs provide those lessons really well because you can have a lot of confidence that if you consistently top up into a broad mix of investments, you're going to get that great outcome over the long run, and then it's going to set up the kids not only financially to be able to use that money, whether it's for a house, a car, a holiday, or for university, but also set them up from a money lesson point of view. Having seen the growth over the last 10 or 20 years, they can take that lesson when it comes to managing their own money. And ultimately, I think that is the most valuable thing you can give your grandkids is education and learnings about how they can manage their money for the next 50 years.